You know, folks always talk about finding the Oracle of Omaha, but let me tell you, when it comes to investing, there's another legend you need to know. John Bogle. This man, the founder of Vanguard, wasn't just selling investments. He was sharing a philosophy, a roadmap to financial peace of mind. Bogle always said it wasn't about getting rich quick, it was about getting rich slow the right way. And that's what we're diving into today. Bogle's 10 simple rules for investment success. Whether you're just starting out or you've been at this for a while, these rules are timeless, just like the wisdom of John Bogle himself. So grab your notepad, pour yourself a glass of something refreshing, and get ready to learn from the best. Let's unlock the secrets to building wealth the Boglehead way. Now, you ever notice how in the investment world everyone wants to chase the hottest stock? It's like trying to catch lightning in a bottle. But John Bogle, he was a patient man. He knew that what goes up must come down. That's the essence of reversion to the mean. Think about it like a rubber band. You stretch it far enough, eventually it's snapping back. Same thing happens with stocks. Companies can have periods of incredible growth, but eventually they settle back to a more sustainable pace. Take Cisco Systems back in the dot-com boom. Everyone and their uncle piled in, thinking it would keep skyrocketing forever. But guess what? The bubble burst, and investors who bought at the peak learned a tough lesson about reversion to the mean. This isn't to say you can't make money from growth stocks, but you've got to be realistic. Don't bet the farm on a company simply because it's the flavor of the month. Look for long-term value, not short-term hype. Remember, as John Bogle said, the more you trade, the less you keep. Don't get caught up in the frenzy. Keep your head down, focus on the fundamentals, and let the market do its thing. They say patience is a virtue, and in investing it's practically a superpower. See, the real magic of compounding is like watching a tree grow. It might seem slow at first, but year after year, those rings keep adding up, and before you know it, you've got yourself a mighty oak. Even Einstein himself, a pretty smart fella, called compound interest the eighth wonder of the world. And you know what? He was right. It's the closest thing to financial magic we've got. Let's say you invest $10,000 and earn a steady 7% return each year. After a decade, you're not just doubling your money, you're looking at almost $20,000. And after 30 years, you're well on your way to $80,000. That's the power of time and letting your money work for you. Now, I know what you're thinking. Oh, Warren, that's a long time to wait, but that's the whole point. Investing isn't about getting rich quick, it's about building wealth steadily over time. It's about planting those seeds, giving them time to grow, and reaping the rewards years down the line. So be patient, my friends. Let compounding work its magic. Remember, the earlier you start, the more time you have for your money to grow. Now, I've seen my share of market ups and downs, and let me tell you, it's enough to make even the most seasoned investor a little jittery. But John Bogle, he had this saying, buy right and hold tight. Simple words, but boy, are they powerful. Buying right means doing your homework. It's about understanding what you're investing in, looking at the fundamentals of a company or a fund, and making sure it aligns with your long-term goals. It also means not getting caught up in the hype. Don't buy something just because everyone else is. Remember, what goes up quickly can come down even faster. Look for value, for solid companies with a good track record. And once you've bought right, then comes the hold tight part. This is where a lot of folks get tripped up. They see the market dip and they panic. They sell low, locking in losses and missing out on future gains. But you see, the market, it's like a bucking bronco. You're going to have your ups and downs. The key is to stay in the saddle. Don't let short-term fluctuations derail your long-term plan. Remember, time is your friend. So buy right, hold tight, and let the market do its thing. Chapter 4. Have realistic expectations. Now, we all love a good success story, right? But when it comes to investing, it's important to keep our expectations in check. John Bogle, he used to explain it like this. Investing is like buying a bagel, speculation is like buying a donut. See, with a bagel, you know exactly what you're getting. It's simple, it's reliable, it's not flashy, but it's good, solid nourishment. That's investing for the long haul. You're not looking for overnight riches, you're looking for steady growth, for a portfolio that will sustain you over time. Now, that donut, it might look tempting with all that sugar and sprinkles. That's speculation. It's exciting, it's risky, and yeah, it might give you a quick sugar rush, but it's not going to sustain you in the long run. Too many folks get caught up chasing those donuts, those hot tips, and get-rich-quick schemes. They're looking for the next Apple or Amazon, hoping to strike it rich overnight. But the truth is, those are the exceptions, not the rule. Real investing, the Boglehead way, it's about slow and steady wins the race. It's about setting realistic goals, understanding that there will be ups and downs, and staying the course. So ditch the donuts, stick with the bagels, and you'll be well on your way to building a solid financial future. Chapter 5. Forget the needle. Buy the haystack. You know, a lot of folks spend their lives trying to find that one magic stock, the needle in the haystack that's going to make them rich. But John Bogle, he had a different approach. Forget the needle, buy the haystack. What he meant by that was, instead of trying to pick individual winners and losers, which, let's face it, is about as easy as predicting the weather, why not just own the whole haystack? Why not own the entire market? That's where index funds come in. These are like big baskets of stocks that track a particular market index, like the S&P 500. When you invest in an index fund, you're essentially buying a tiny piece of hundreds of different companies. Now, some folks might think that's boring. They want the excitement of picking individual stocks. But let me tell you, boring can be beautiful, especially when it comes to building wealth. Index funds offer diversification, which is just a fancy way of saying you're not putting all your eggs in one basket. And they're incredibly low cost, which means more of your money is working for you, not lining the pockets of some high-priced fund manager. So forget about trying to find that needle. Embrace the haystack, invest in low-cost index funds, and let the power of the market work its magic.
Chapter 6. Minimize the croupier's take. Now, you ever walk into a casino and notice how fancy everything is? The chandeliers, the carpets, the free drinks. Well, let me tell you, all that glitz and glamour, it's not paid for by the winners, it's paid for by the losers. The same thing goes for the investment world. Every time you trade a stock, there's someone on the other end of that transaction taking their cut. They're like the croupier at the casino, raking in those fees whether you win or lose. That's why John Bogle was such a big advocate for low-cost investing. He knew that every dollar you pay in fees is a dollar that's not working for you. It's a dollar that's not compounding, not growing, not helping you reach your financial goals. Now, I'm not saying all fees are bad, but you've got to be smart about it. Ask yourself, am I getting my money's worth? Is this fee justified by the potential returns? If you're paying someone a hefty percentage to manage your money, they better be delivering stellar results. And even then, you've got to remember, those fees can eat into your profits over time. That's why, more often than not, you're better off keeping it simple. Stick with low-cost index funds, minimize those trading fees, and let the market do its thing. Remember, the less you pay in fees, the more you keep in your pocket.
You know, a lot of folks come to me looking for guarantees. They want to know, Warren, how can I invest my money and be absolutely certain I won't lose a dime? And I tell them, well, you can bury it in the backyard, but even then, inflation might come along and eat away at it. See, there's no escaping risk. It's just part of the game, but that doesn't mean you have to be reckless. John Bogle always said, risk is an integral part of investing. It cannot be avoided, but it can be understood and managed. The key is to understand the different types of risk. There's market risk, which is the risk that the entire market could go down. There's interest rate risk, which is the risk that rising interest rates could hurt your bond investments. And there's inflation risk, which is the risk that your money will buy less in the future than it does today. Now, you can't eliminate these risks entirely, but you can mitigate them through diversification. By spreading your money across different asset classes like stocks, bonds, and real estate, you're essentially hedging your bets. The key takeaway here is this: don't be afraid of risk, but don't be reckless either. Understand the risks you're taking, diversify your portfolio, and focus on the long term.
Chapter 8. Don't fight the last war. Now, I've seen a lot of investors come and go over the years, and you know what I've noticed? A lot of them are fighting the last war. They're so busy looking in the rearview mirror, they miss what's right in front of them. They're chasing yesterday's winners, buying up stocks that have already skyrocketed, thinking they'll keep going up forever. But the market, it's a forward-looking beast. It doesn't care what happened yesterday. It cares about what's going to happen tomorrow. John Bogle, he understood this better than anyone. He always said past performance is not indicative of future results. Just because a company or a fund has done well in the past doesn't mean it will continue to do well in the future. In fact, often it's the opposite. Companies that have had a great run often become complacent. They rest on their laurels, and before they know it, they're being overtaken by hungrier, more innovative competitors. The lesson here is simple. Don't get stuck in the past. Don't chase yesterday's winners. Instead, focus on the future. Look for companies and funds that are well positioned for growth, that are adapting to changing market conditions, and that have a solid plan for the future.
Chapter 9. The hedgehog beats the fox.
Now, you ever hear the old saying, the fox knows many things, but the hedgehog knows one big thing? Well, in the world of investing, the hedgehog is the index fund, and the fox is the active fund manager. See, those active fund managers, they're like foxes.
They're always darting around trying to outsmart the market, picking stocks, timing their trades. They're always trying to find an edge, but all that activity, it comes at a cost. They've got teams of analysts, expensive offices, and of course those hefty fees they charge investors. And all that activity, it doesn't always translate into better returns. In fact, more often than not, it underperforms the market. The index fund, on the other hand, it's like the hedgehog. It's simple, it's low cost, and it just keeps rolling along, tracking the market year after year. No fuss, no muss, just steady, reliable returns. Now, I know what you're thinking, but Warren, surely those smart fund managers can beat the market, right? And yeah, some of them do some of the time, but consistently, year after year, it's incredibly difficult. So if you're looking for a simple, effective way to invest your money, stick with the hedgehog. Embrace the index fund. It might not be glamorous, but it's a proven way to build wealth over the long term.
Chapter 10. Stay the course. Investing can be an emotional roller coaster. You've got greed and fear battling it out in your head. The market's going up, the market's going down. It's enough to make anyone dizzy. But that's why it's so important to have a plan and to stick with it. John Bogle, he understood this better than anyone. He always said the biggest enemy of a good plan is the constant and quite human desire to do something quite different. See, when you react emotionally, when you let fear or greed drive your decisions, you're more likely to make mistakes. You're more likely to buy high and sell low, to chase performance, to jump from one hot stock to the next. That's why it's so important to have a long-term perspective. Remember why you're investing in the first place. Are you saving for retirement, for your kids' education, for a down payment on a house? Whatever your goals are, write them down and keep them front and center. That way, when the market inevitably throws a curveball your way, you'll be less likely to panic. And remember, your investment plan, it's not set in stone. It's a living, breathing thing. As your life changes, your goals change, your risk tolerance changes, so too should your plan. Review it regularly, make adjustments as needed, but don't abandon it altogether just because the market is going through a rough patch. Outro, the Boglehead Way, your path to financial success. So there you have it, folks. John Bogle's 10 simple rules for investment success. Remember to keep your head on straight, think long term, and don't overcomplicate things. Stick with low-cost index funds, diversify your portfolio, and let the power of compounding work its magic. These rules, they're not about getting rich quick. They're about building wealth steadily, responsibly, and with peace of mind. They're about achieving financial freedom so you can spend your time doing the things you love with the people you love. Now go out there, be a Boglehead, and take control of your financial future. And hey, if you found this helpful, hit that subscribe button. We've got a whole lot more investment wisdom to share.